Welcome to the Startup Grind.
Stop. Oh, dang it.
Okay.
I'm sorry. I'm more familiar with WebEx, so I'm like, ugh. So share. Okay, Bob, are you able to share, or does I have to stop? Oh, here it
I
is.
am, but you're still share.
There you
There we
go.
go.
There you
Okay.
go.
Yeah, you're good. You're good. Okay. So I'm sharing my screen now, but my presentation. Before I get into the details, I do want to, yeah, as mentioned, tailor our discussion today to address your immediate needs. Um, so maybe Darren, I know you're on the road, but maybe Inder, you can share a couple points of what you're working on. What's your immediate question today? Are you at a company formation stage? Are you at a fundraising stage? Where are you at?
Um, I'm mostly planning to what is a bootstrap. So at this stage, I'm more interested in like the company for
Okay.
formation and like just making sure being protected from both from a legal standpoint as well as having my financial ducks in an order to make sure I have like a sustainable runway.
Okay. So we can talk about LC, C-Corp, differences, pros and cons. We can talk about that. Uh, Oigi, I'm not sure if I can pronounce that
Yeah,
correctly, but maybe
hi,
you can, yeah. Hi, good to meet you.
good to meet you. So my startup is very at early stage. It's a health tech startup, and so currently it's just me and my advisor. So, but
Okay.
I'm always trying to learn new skills and new knowledge. So happy to join here.
Okay. Wonderful. Okay. Anil?
Um, I'm mostly a early stage startup. We are we're looking to raise like pre-seed
Okay.
round. So we are an AI
Okay.
startup. Yeah.
Got it. And what's your biggest question today?
Mostly company formation
Okay.
and structuring the equity. We plan to bring in advisors later in the journey. So we're already planning for it, but we are looking for advice on how do we structure and how do we value the company. We are also
Mhm.
pre-revenue, so we just don't know how.
Yeah. Damien, how about you? What are you working on today, and what's sort of a burning question that you are thinking about today?
That's a great question. I'm just kind of found out about this. I'm just pretty interested in this. I'm in real estate,
Okay.
so I'm kind of just dropping in and curious.
Yeah. All good. Darren, how about you?
Hey everybody. Yeah, I'm at the early stage. It's kind of interesting. I started an MVP of my company to just test the product market fit and see if there was an something to go after. And then I basically iterated to the point of where I am now. I bootstrapped the whole thing, but I'm just at the point where I think I probably need some external funding because I see a bigger opportunity. So yeah,
Okay.
pre-funding, bootstrapped, about 18 months in.
Wonderful. Great. So we can talk about what investors want to see in a growing firm. Khalifa, good to meet you. I'd love to just hear what are you working on today or these days, and a burning question that you might be thinking about these days. You can tap that into chat, Khalifa, later as well. Okay. So let me fly through my presentation, and then we can get into those Q&A. Hopefully that my presentation addresses some of these items as well. So my mission is to build enduringly profitable companies. My company's Tee Up Advisors. The tagline is Tee Up the Next Generation. So before everybody joined, Marianne and I and Rich, we talked about basically how do we scale responsibly, and that's what this is all about. We don't want to burn up, and there's a saying, more companies die from indigestion than starvation. So managing growth, managing cash flow is a really important part of growing sustainably. I reviewed many companies, and the most resilient companies, the most enduringly profitable companies, I believe, have these 5 common buckets of characteristics. One is they are financially stable, they have loyal customers, they have high quality of revenues, and that's what investors look for, especially pre-seed. You raise them an idea, great. As soon as you start getting revenues, you got to start tracking revenue metrics, net retention, ARR, CAC to LTV. We can get into that, but that's super key. Aware and manage your risks. So if you're profitable, if you're startups, your investors will ask you, what are your biggest risks and how do you plan to address it? If you don't come up with the narrative, your investors will. And I highly recommend that you control that narrative. Then you got to think about that up front. Cohesive teams. So you may not have a team now, but eventually you will. Creating stock options as part of that, as part of company formation, leaving room on your cap table to reward employees down the line is going to be one key part of building cohesive teams. And then align stakeholders. So this is a really big weakness for first-time entrepreneurs. The last slide is, basically no drama. And as you grow, as you scale, as you bring on other stakeholders, board members, investors, lenders, everyone has a different incentive, right? And crafting your message to align with what they want is going to be the best way to reduce drama. And drama, no drama creates resilience, right? Aligned stakeholders. So, how do I define financial stability? I think there are 4 subcategories. One is a rule of 30. So in tech, there is a metric called the rule of 40. Now, the rule of 40 typically applies to mature businesses, mature tech companies like Dropbox, Evernote, Google. They follow the rule of 40. The rule of 40 means percent of growth, year-over-year growth, plus percent of net profit equals roughly 40%. So if a tech company is growing by 20% year over year and the net profit is 20%, then 20 plus 20 equals 40. If you have a more traditional business, then rule of 30 is a good rule of thumb, where you're growing by 15% and your net profit is 15%. If you are following those metrics, then your company is going to be super valuable. Again, this really applies when you start to scale and have revenues. Visibility of KPIs. So, maybe not as important pre-seed, but as soon as you start having revenues, as soon as you start hiring employees, you got to start tracking these KPIs because your investors will want them. Revenue metrics, expense metrics, conversion metrics, marketing metrics. Ideally, you don't want to just have them. You want them to drive behavior. So your VP of marketing or your marketing manager, team member, they are rewarded, compensated, bonus based on this KPI doing XYZ, right? So you got to make sure many people have KPIs, but very few have those KPIs drive behavior. The last piece is what you got to look for. The cash flow. You want to get cash flow as early as possible. Not sure if it's part of this slide, but there are kind of 2 types of businesses. You have the traditional cash flow model, and then you have the pre-funded cash flow model. So if you think about, let's say, Amazon e-commerce store, right? The product needs to be made, shipped, inventory before you can make your first dollar. That's a lot of cash out before you see any cash coming in. That's not as good. Similar to consulting firms. A lot of firms, they do the work and then bill later. That's very, very cash flow intensive. This is where SaaS is great, right? You pay up front. You pay for the next month of services. You want to get the cash up front. Even some enterprise software companies, they want to charge annually. So they charge you up front for the whole year, and then they use that money to pay for employees and development and so on for the remainder of the year. That's a beautiful cash flow model, right? That's what we call a negative cash flow business, where you get prepaid before you sort of earn the dollar. So as you're thinking about your revenue model, the more you have a negative cash flow conversion cycle, it's like minus 120 days, minus 360 days, the better. So yeah, eventually, if you want to get to a place where you're charging annually or 2-year packages or 3-year packages, that'd be even better. You're getting paid 3 years up front. The last piece, if for an enduringly resilient business, a financially stable business, is eventually you want to think about M&A. Keep that in mind. All strong companies have the opportunity to pick up competitors or businesses that may be a good fit for a good price should the opportunity arise. At this point in time, I guess we can also talk about financially stable, but also the right corporate structure, right? For a lot of companies here, while you're still in the formation stage, I think there are mainly 2 types of companies that are available. I'll touch on B Corp later, but so LLC is a very easy way to get started, but it's not very scalable because it's hard to have 1,000 shareholders in an LLC, and there's restrictions on taxes and things like that. Typically, if you want to be raising money from international investors, from VCs, a Delaware C-Corp is something you want to look at. That being said, you can always convert later. So LLC is the most flexible tax structure. You can convert an LLC into a C-Corp when it makes sense. The challenge with a C-Corp is it is a independent entity. It's a corporation. It has articles of incorporation. You got to get lawyers involved. You have share registers. So there's a more entity to maintain, but it is the standard fundraising vehicle. But if you want it to be closely held and it's just for you want to bootstrap it, you want to start off easy, and LLC is a great way to go. Marian, you mentioned a B Corp. B Corp is actually not a legal status. It is a way to, demonstrate to the world that you are a environmentally, socially responsible organization, and it's a status that you can sort of work towards, an organization you can join. But legally, like in IRS sort of drop down list, B Corp is not a legal status. It's more of a social status. I'll pause there. I said a lot of things on how to be financially stable, rule of 30, KPIs, cash flow, also tax structure. Any questions?
You mentioned that LLC is a good place to start. It sounds like, and I just want to make sure I understand this right. If you start with an LLC and your intention is to ultimately raise outside funds, whether that's just angel funds, or if you eventually decide to grow to an A round or a B round, do you convert to a C Corp? Is that the typical process, or should you start as a C Corp from the beginning?
So starting from the C Corp from the beginning is the right way to do it.
Got it.
But it's also the more expensive way to do it because it's, I would say, at least $2,000-3,000 a year to maintain that entity. LLC on the other hand costs like, I don't know, $100, $1,500. It's $100 to set up, and then I don't think it has any other annual maintenance fees because you just file taxes sort of on your own return, right? So there's a cost benefit to it. You want to do it right, Delaware C Corp, like that's the answer. But realistically, if you're bootstrapping it, be efficient with your capital, right?
Yeah.
And then you can always convert later.
Yeah. Okay. Thanks.
Good. We had a couple of structuring questions. Have I answered that piece? Inder, you're good. Anil,
I have a
you're
question.
good. Yeah, go ahead.
Are there any risks during the conversion? Like, are we less attractive because we were an LLC before we became a C Corp for investors?
No.
Okay. Thank you.
So we will move on. When I was a CFO of a tech company, religiously we tracked customer metrics. Now, when I was running a tech company, it was boom days, and we didn't care about profitability. And you didn't have to be enduringly profitable. These days, regardless of startup you are, profitability is always sort of on people's minds. The VC environment has changed, but regardless of what environment you're in, it's always good to have profitability as a potential outcome, so you don't have to raise. Like, fundraising should almost always be an option, not a necessity, because you never know when you're going to get your next round. And regardless if you want to raise, having your customer metrics down, growing, improving, that's going to be super key. So one is percent of recurring revenues. Let me touch on that a little bit. There are, I would say, 4 types of revenues. There is one-time revenue, which is the least valuable kind. There's repeat revenue. There's occurring revenue, and there's recurring revenue. Repeat revenue is like a customer comes to the coffee shop. You don't know when they're coming, maybe. That's repeat. Recurring is kind of like an accounting firm, consulting firm. They come once a year. You probably know they're coming, but you see them once a year. Hopefully they come. Accounting firm, consulting firms, they come like that. Like, Justin, I think some clients you have recurring, but some they come to you once a year. I don't know. I'm just guessing. But you have these. You said a lot of your workload happens in December. Presumably, upon renewal, you have a lot of discussions.
Yeah.
Recurring, you have a software product. You want them to be paying you monthly or annually. They're on a contract. That's the most valuable kind of revenue. So as you're thinking about your revenue model, try not to charge for, the visit, the interaction, and so on, and try to charge for a monthly subscription. That being said, there is a trend to charge for usage, or like a combination of. So you charge a $10 a month recurring fee, but you charge per byte, per API call, per whatever that sort of makes sense, or per dollar, 0.5% transaction fee or something like that. So there's always an exception, but generally speaking, recurring is more valuable. Terry, you had a question? Maybe? Okay. Going back to the slide of quality of revenue, loyal customers, the other big metric is customer retention. So the metric here, if you're a software company, if you're any company, the percent that you should target is more than 100%. So how does that make sense? If you have 100% customer retention, that means you retain all your customers. That's fantastic, amazing. If you have 90% retention, could be better, right? I've seen some companies that don't have a lot of repeat revenue. Their customer retention is 25%. That means or even it's really bad, right? That you have to get new customers every year, all the time. How do you get to 110% retention, 120% retention? That happens when your customers start to grow with you. So you retain all your customers, fantastic, and they all grew with you. Their usage increased, their users increased, their revenue base increased, and so they were paying you $100 a month last year. Now they're paying you $110 a month this year, and you retain all your customers. That's where you want to get to. That is an extremely valuable company. Does that make sense? Customer concentration is something you want to avoid. General rule, you don't want to have more than 20 or 30% of your revenues concentrated with one customer. If you do that, your business is unsellable. You cannot raise money on a business that has 30% customer concentration. Does that make sense? It's pretty straightforward. Okay. And then gross profit per customer. So this is more for project-based companies, but You want to make sure that your unit economics are good. So example is Uber. Before they were subsidizing all the riders. Airbnb, they were subsidizing all the renters. And the reason why you saw all the rates increase is because that's not sustainable. You want to make sure that every thing you do, every month, every charge, you are making money. We are no longer in a VC environment where, usage is subsidized, unless you're AI, unless you're generative AI. Even then, who knows? The attitude may have changed from Monday to today because of DeepSeek, right? So you want to make sure everything you do, if it costs you $20, you're charging 20, you're charging 40, 60, $100 for that service. Because keep in mind, if you're a true SaaS company, your gross margin should be anywhere from 80 to 90%. If you're a medical device company, your margin should be 50% at the minimum. Because keep in mind, you have R&D costs, right? Your gross margins are fantastic, but you got to pay for your engineers, you got to pay for marketing, you got to pay for sales. It's expensive to grow a startup.
Can I inject a question there?
Yeah.
My business is analogous to sort of an Airbnb style of model. So my unit economics, my raw unit economics are great, right? I have a high profit margin because I don't own the asset. But as I'm scaling, my unit economics fully baked with marketing and everything else are actually not particularly good. But it's something that I'm expecting for a period of time until I reach a level of brand awareness and scale. If I heard you right, it's like the negative unit economics of the Uber and Airbnbs in the old days are no longer really considered viable for investment. Is that true across the board for even a business like what I'm building, or is it just the ebb and flow of the funding environment?
It's ebb and flow for sure. Unless you're AI, investors are not interested in subsidizing usage anymore.
Yep. Okay.
Not in today's interest rate environment, right?
Yeah.
Even like I mentioned, even AI based startups, they're that runway is getting short.
Yeah.
And to your point, so I mean, there's unit economics. I would say sales and marketing. I don't know. I'll have to take a look, but if you're sort of marketing for a transaction, then that's worrisome. But this is where like the CAC to LTV ratio comes in, right? How much it costs you to acquire a customer, and
that's
what's
what I'm working. I'm working to
value.
figure my LTV out now, so I can figure out what my CAC can be. But I don't have that equation fully baked yet, so that's kind of why what you said kind of piqued my curiosity.
Yeah, and that ratio should be at a minimum 3.
Yeah,
to be a sort of gold standard, right?
Got it.
Anil, over to you.
Yeah. So my startup has 2 types of customers. Like we cater to B2B and also B2C. I mean, we are targeting B2B first. But since you said the concentration of revenue from 30% is not ideal, is there a golden ratio, so to speak, on how this should work? Because enterprises technically pay more and they have a higher contribution to the revenue.
Yeah, the math is still the same. If your one big enterprise customer is 50% of revenues, you're not fundable. You have one customer. So I would say, turn your focus to finding another enterprise customer. If you have 2 enterprise customers, both doing, 40% of revenues, well, I could say basically you're just diluting that percent, right? You get a third enterprise customer. Oh, you're a business now. You're not just like an experiment. And that's when you can get some funding.
Okay, sounds good. Thank you.
Yeah. Okay. Understanding your risks. So it's going to be different for everybody, but on a slide, when you're going to fundraise, when you're talking to board members, you should always have risks and mitigations, right? Broad categories of risks, this again all depends. Financial risks, how interest rates, debt levels, pricing, tariffs, how that's going to impact you. That's, I guess, geopolitics, tariffs, war, commodities, oils, how that's going to impact you, housing prices, technology, AI, offshoring, new tech, people in HR, so immigration policies and labor laws. So much happening these days, right? Anything that impacts your business, you should have an answer, because if you don't, your investors will come up with their own answers. And it's typically not good. Okay, cohesive team. So these are metrics these are metrics you pay attention to as you start having a team. Employee turnover, super important, right? And that's new employees divided by total prior employees. Not important now, but like as you have a team, that's important. Employee happiness score. So in marketing, you have a NPS score, which is a net promoter score. That's to measure how satisfied your customers are with your product. The same metric can be applied to your internal team members to measure how satisfied your team members are with the work environment. Training and development. So your employees are your biggest asset and your biggest liability. So having a training budget as you sort of create your own finance plan, that's going to be important. And then as your team grows, you want to make sure that their compensation is in line with industry. The last thing you want is, next year half your team quits because you're underpaying them. Like that's a big risk that you don't want to be surprised with. This is also where if you are underpaying them, that's okay. Just pay them a little more in equity, right? Have that balance. Okay, the last piece of a enduringly profitable company, valuable company, is stakeholder alignment. This is typically the weakest part of an entrepreneur. An entrepreneur, an engineer, an idea person has typically not interacted with a board of directors, investors, lenders before. And everyone has a different view of the world. So investors, if you're talking about VC, private equity, they're typically like finance people. They want to know budgets and forecasts and, like everything you ask for, every idea has to translate into, okay, like what's the increase in revenues? Or like, okay, how does that increase the value of the company? For example, you just sharing features to your investors, that's not good enough. You need to translate how those features translate into more revenue, more customers, more pricing, more margin. You got to make that jump. Okay. It's different if you're talking to a family office or wealthy individuals, and typically if you hype them up, they'll invest. Great. But eventually you're going to hit a hurdle with that crowd. Lenders, in addition, what you're not seeing here is government grants. So if you're in a medical tech space, if you're in a place where you can apply for grants, every grantor has criteria. So you got to frame up your product or your solution in a way that addresses their goals. The other big piece of big advice I want to give to you as you're raising money and talking to investors is stop talking about your product, start talking about your solution. Okay? So people don't care about the hammer, they want to see a hole. I've talked to a biotech clean coal engineering product, and their entire slide was all about how their process is 10% better than the industry, and this is how they do it, yada yada. But I'm like, okay, like so what? Like so many dollars, So keep that in mind in your storytelling. Lenders, and sometimes you want to pursue venture debt. So again, they don't want to hear features. They don't even want to hear that you're going to be growing by 1,000,000% next year. They want to hear how you're going to pay the loan back. They want to hear how you're going to generate cash, how you're going to get customers, how customers prepay you, how their capital is preserved. So the whole point is that you have to have a different story, even though your facts are the same. The next piece is, family business, wealth plan. Hopefully you make it big. Hopefully you have a big outcome. It's important to start thinking about that now. Go ahead, Darren.
Yeah, with regard to lenders, I was thinking about convertible note lenders, and I assume that I think about lenders in two different categories, and I'm wondering if I'm thinking about it the right way. One of them would be just straight, hard money loans versus convertible notes, and I'm thinking that the convertible note guys might be looking for when is your next liquidation event, whether that be a round of funding or something else. Is that a fair
Yeah.
way to think about those two different kinds of lenders?
Yeah, exactly. Convertible note, also safe. If you think about the nature of convertible note, where do they make the money? They don't make the money in the interest payments, not really. Convertible note, they're more like equity holders. So your storytelling should be leaning more towards how they're going to have a big outcome because they want to convert. They want
Got
you
it.
to convert, right? They're not going to make money on 12% interest.
Right.
Right? That note feature is to protect the downside. What they really want is the upside.
Thank you.
Yeah. Okay. So where can I support you? There's a lot of ways I can support. We can have these calls. You can have Q&A. I can support with fundraising, reviewing pitch decks, reviewing term sheets. I can be, your partner in that. Once you start sort of making money and things are going well, we can do a enterprise value estimate. So we talked about valuation. If you are making profit, it's a lot easier because it's just a multiple of profit. If you're doing sort of revenue valuations, then we should have to get comps in the past 12 months, and we can sort of work on that together. You talked about what percent, how much is my value today, what should I raise on, and what the dilution is. There's ways you can raise without having to disclose what your valuation is. But if you need to know value, we can work on that as well. Yeah, so that's the main presentation. And then, Marion, you want to talk about SBA lending, LBO M&A?
Yeah, just like alternative sources for funding for especially the smaller, somebody in between that bootstrap stage and seed stage where, maybe you're starting to make some money and you can start making loan payments. So it's looking like a more feasible option. But the environment right now is a lot different than it was obviously pre-COVID and pre-interest rate hike. So, I mean, I'm just seeing there's a lot of and SBA loan uncertainty, especially in the past couple of days. Because that's a big source of funding. What other alternatives or other opportunities are you seeing come up for those little in-between scaling up loans and stuff?
Yeah, sure. Yeah. For a good idea, good product, for a good deal, there's no shortage of money. SBA is very restrictive. Many of my colleagues who are in acquisitions, in the business of acquiring other companies, they don't like using SBA because SBA requires personal guarantees and they don't want to give it. So there's mezzanine debt, there's venture debt, there's private credit, there's convertible note, there's safe notes. So there's all sorts of different ways to raise funds. So I guess, at that moment when you're ready, talk to me and we can brainstorm what's out there. But yeah, if you have a good idea, you're showing good traction, this is least of your worries. But we can talk some of that. Are you guys interested in learning what mezzanine debt is, senior debt, private credit? Yeah.
Yeah, I'd be interested in learning a little bit more about that and then where you go for each of these vehicles.
Yeah, sure.
Yeah,
Yeah,
I'd
Anil,
be
go ahead.
interested to see what the outlook is for private credit, but on that smaller side. Or is there a private credit market for 5 million or less, or those smaller loans 1 million or something like that?
Yeah, for sure. Anil, go ahead.
Um, I have a little bit of a different question. I'm wondering, can you talk a little bit about like what kind of traction numbers do you need to hit before you can consider you're ready for funding?
Sure. Yeah, so let me talk about some of those. So the most traditional debt is called senior debt. That's the debt you get from a traditional bank. They're the most conservative, lowest cost, um, and the most restrictive. So if you go to Bank of America, Chase, that's where you get a senior debt. And then you get into the mezzanine debt. Mezzanine is kind of like in between, and they can be kind of a secondary lender. So sometimes you have a senior debt that takes the first position, and then you have a mezz debt that takes a secondary position. So it's kind of like a second mortgage on your asset kind of thing. So in the event of bankruptcy, a senior lender gets to get their portion repaid first, and then it's the mezzanine lender. Private credit, it could be anywhere. It could be just, private credit can take the position of a senior, can take position of a junior, can take what they call a unitranche, where they sort of combine it, or it could be a combination of debt and equity. So private credit could be, you give me 10% equity and and here's a $5 million line. In exchange, I want some warrants, I want some equity, so they can be it can be super flexible. And every private lender has their own desired capital structure. You talked about trends. Yeah, I don't know about trends. I mean, it changes all the time. The interest rates remain the same. That's a change in the sense that it was not a change. I think people were expecting a rate decrease. It didn't come. So, there's impacts there. But let's see, the higher the interest rate, the more expensive the debt is, the harder it is for you to get. During the pandemic, the loan covenants were very, very restrictive. These days, they've loosened up. They're willing to lend more based on the same criteria. But yeah, that's what I've seen so far. Oh, in terms of where to get them, yeah, senior debt, your local bank, credit union, mezzanine debt, private credit. You can just Google it, like mezzanine debt in my area, private credit in my area. But those types, you typically want to go through your network. So I have a network of people that are in this space. I'm happy to give you some recommendations. Some could be loan sharky, so definitely want to avoid those. The reputation is going to be super important. Private credit, mezzanine, they have their own areas of specialty. So some only lend to healthcare, some only lend to manufacturing, some only lend to, they have their own credit box, is what they call it. So very varied. Marion, does that high level address your questions?
Yeah, I'm just kind of, as I'm talking to people and I'm getting some ideas, I like to see what the environment is looking like, especially with the
Yes.
higher interest rates. So you have to go for more non-traditional stuff.
Yeah. Darren, does that help answer where to get that loan, that money?
Yeah, that does help. I appreciate that.
Okay, cool. And then Anil, you talked about what the metrics have to be. Yeah, so it depends on stage. What's your pre-revenue, Anil, right?
Yeah, that's right.
And pre-revenue. And you want to raise pre-revenue or do you want to raise post-revenue?
I mean, ideally pre-revenue, but I don't think it's from what I've learned, it's not looking good.
Right. Yeah, it's pros and cons, as I'm sure you've seen the Silicon Valley TV show. When you're pre-revenue, you can raise on whatever until you start making money. It's like, oh, you're not a unicorn anymore. You're a real thing. We got to start measuring you on a real KPIs. So similar, that has some truth to it, especially now. Unless you're something super unique, you personally are super unique. Raising pre-revenue is going to be very challenging. You can raise from angels, obviously, but ideally you want to have some traction. And this is what we're talking about. Percent of recurring, as high as you can get it. Customer retention, at least 100%, right? Customer concentration, no higher than 20 or 30%. Gross profit per customer, depends on where you are, at least north of 50%.
Right.
Those are minimums, I would say.
Thank you.
And okay, financial habits. That's a good question. Yeah. So I know it's annoying, but definitely get your corporation set up. LLC, C-Corp, make that decision, get it set up, put all your IP expenses all in there. Another good, really important habit, separate your personal and business. Get a business credit card. I have a really good fintech partner called Bro, RHO. Happy to give you a referral there. They are really, really helpful in getting startups going. What else? What are the most common financial managed risk AI startups face, and how can we plan for them? The other really annoying thing, but you have to do it is get your bookkeeping done, cleaned up. I'm working with again, that biotech company that's trying to fundraise. They have not filed taxes for 3 years. Granted, they don't owe any taxes because they're not making any money. They're in loss position. But no one's going to fund them if they're not compliant. They are not compliant with the IRS right now. And nobody's going to fund them because of that. So you don't want your lack of bookkeeping, lack of filing tax returns to be the reason why they're not funding you, right? So I know it's annoying, but get your bookkeeping done, get your taxes filed. Keep your business and personal separate. Common risks of managed risk AI startups. I think those things are very common across the board. Yeah, I don't know, Luigi, you want to clarify or maybe discuss what common other, unique AI startups face? I don't know if you have any more context than that.
No, yeah, just in general, I was wondering if you have learned about or experienced.
Yeah. The other thing to think about, just because your AI doesn't, preclude you from making money, maybe for the first year or so, but you got to have a revenue model. So when people ask you about, hey, you have a cool solution, you have AI here, but okay, how is that going to make money? How is it going to make me more efficient? What's the value here? I think the questions are still there. QuickBooks is live. Yes, indeed. Wave is fine. Yep, perfectly fine. FreshBook is great as well. QuickBooks can be expensive for a startup, so I can see that. Yeah, I think that's about it. Aaron, anything else?
Actually, yeah, let me ask kind of sort of a different question too. As I was evaluating my business, when I first started looking at it, I made the determination that it was not a venture scale business. I thought it's not $1 billion business. I mean, it could be several million. I think it's easily several $1 million of a business opportunity. As I've gotten into it, I think the opportunity is bigger than I originally thought. But I'm still not convinced that it's a venture scale business in that I don't see a 20x exit multiple on a market opportunity in the 9 figures. So I'm actually kind of wondering what sort of investor would be interested in backing this business. I mean, it's definitely a high margin, very viable business, but it's not a venture scale business. So
Yeah.
I've been kind of thinking that this is maybe more tailored to, and it's in a niche market. So I've been kind of thinking it would be more tailored to angel investors that like the space because they personally enjoy it, and they also see a potential for a return on investment as maybe a recurring dividend share, from the business, or potentially an exit at some point down the line. Um, I'm curious about. I sort of feel like I'm stuck in this weird middle. I'm not like the coffee shop on the corner, but I'm also not the billion-dollar business. I'm sort of stuck there in the middle. Can you speak to kind of what type of investors would be looking at businesses like that for investments?
Yeah. What do you need investment for?
Um, well, I'm in a single market now, and the investment would be to do a couple of things. It would be to continue to solidify the product line in the current market, but then to expand into additional markets as well.
Okay. So there's a couple of ways we can go about it. You're not looking for angels because the definition of an angel is sort of more on the venture scale. You got the
Okay.
angel series, seed, pre-seed, and so
Yeah.
on. They don't expect their money back unless it comes with 10 times return.
Got it.
But you're right. You're looking for a cash flow investor. You're looking for the family office is a category.
Okay.
You're looking for wealthy individuals who want to, higher return on their investment than the stock market.
Hmm.
Yeah, it's friends and family.
Got
It's
it.
not institutional, right? But what you could look at is the mezzanine private lending, is
Oh,
the
interesting.
is a line of credit, is the senior debt. Because if you are using the money for the purpose of generating more cash flow,
Hmm.
then you can service that cash flow, right?
Yeah, presumably. I'd love to bootstrap the whole thing, frankly, on cash flow. Mostly
Yes.
just because I think building a business that way is a bit more disciplined. It makes you do a lot of having constraints can be good in a lot of cases.
That's exactly right. In
Yeah,
your case, definitely bootstrap is better. But like if you get debt doesn't allow you to it doesn't force you to give up equity. So
right.
it's if you're sort of stuck in the middle, that's one way to get additional cash for investment without having to give up any ownership,
Okay.
right?
Thank you. Yeah, that's helpful.
Yeah. Back to you, Rich.
All right. Any before we go, any more questions? Like, you are muted now. Hold on. Can you guys hear me?
Damien here. I just wanted to build on that recent exchange. I think that's a great point, Bob, that, institutional money is typically looking to like 10x their money. And so unless you're playing that game, then you're more maybe in this, like you said, family office, wealthy individuals. I think that's a really, for me, critical insight as we all build projects and companies and things of that nature.
Yes. Wonderful. Yeah. I think the media loves to fantasize and publish, fundraising, $50 million round. Yeah. But like there's so many small businesses being built, so many wonderful software products that are bootstrapped or, growing by 20% a year as opposed to 2,000% a year. And yeah, we just don't all have $1 billion product. That's okay.
Totally.
Okay. Can you guys hear me?
Yeah.
All right. So I'm just gonna go ahead and wrap up. Bob, I want to thank you for taking the time and sharing your expertise with our community. And actually, Bob will be presenting in person in March. If you go to Startup Grind /Sacramento, and if you're in the region, you can come in and meet Bob personally. So he'll be presenting in person.
Yeah.
And speaking of in person, so next week we have our AI meetup at Granite City Co-working. We are featuring Hulup CEO Todd Mashad, and he's actually one of the more successful AI. I don't even know if you can call it a startup, but he's got an AI business, and I think he's actually raised tens of millions of dollars for a startup. And I happened to be at an event, and I actually known him in his previous life, and I just asked him if he wanted to come talk to our meetup. So, if you're in the area, that's a great that'll be a great event to speak to come to. And with that, for those of you that are local, thanks for coming and being part of our community.
Oh, one
And
more thing, Rich.
go ahead, Bob.
Yeah, I forgot to mention, I'm always looking for speaking opportunities. So if you're part of other communities that could benefit from this level of discussion, my experience, this presentation, I'd love to present to your network. So yeah, let me know.